Why do you think the SP is down 10.5 in the past 3 months? SPY was $457.79 on July 31. Today, on October 27, it is $410. The market usually reacts to multiple things: geopolitical events, data from reports, GDP, CPI, employment, etc., data from earnings from companies, emotions, the rate of alternative investments like bonds, treasuries, or money market funds that react to the federal funds rate. As far as I can tell, earnings from big companies have been good and not catastrophic. Ukraine-Russia war is nothing new. I don't think Israel-Palestine conflict affects the U.S. market that much. I'm not aware of any issues geopolitically in regards to important things like oil. CPI is okay. Employment is showing the labor market is resilient, resistant to what the Federal Reserve is trying to achieve: stop inflation, which is interesting because it conflicts with their dual mandate of maximum employment. In my opinion, the market is reacting to the realization that the economy is resilient enough to withstand the federal funds rate being 4.5. Which means the Fed will continue to make data-driven decisions that will result in higher for longer. As an estimate, we could argue we hypothetically won't see the Fed do any rate cuts whatsoever in the next 12 months. What I don't get is why all of a sudden the market topped at $457 right around the time of the last FOMC meeting. I remember the updated dot plot projections came out from the Federal Reserve that showed higher for longer and basically kicked off this sell-off. What I don't get is why is it still happening, and why at this rate? Is that really the sole catalyst, or is something else happening I'm not aware of? I'm aware that the higher the 10-year risk-free rate creeps, the worse it is for equities in the next 1 to 5 years. If this isn't the sole reason the market is down 10, I feel like I personally, a retail investor with information available to me basically only through whatever is on the public, free, open internet, have no clue why the market is reacting the way it is. What is the catalyst? Curious to hear your thoughts, opinions. Probably because it was up 2 months prior to this correction. We were due for a 10 correction and market just grabbed whatever negative news there are at the moment. It's a weak seasonal period. It's bound to happen. For people who think it's because of the 10-year rate, 10-year rate went up 1 between March and August. And market rallied like nothing happened. Market rallied through the raising debt ceiling debate and the anticipated excess savings drawdown in the summer. However, now that 10-year rate went up another 0.6. And suddenly it's the end of the world for valuation? Corrections are a good time to buy. It's all of these things, but one thing to add is that China stocks have been in a race to the bottom, hitting a 4.5-year low on Monday. I don't think the world's second largest economy can take a beating and the rest of the markets won't be affected. It's simple. Investors can get 5 risk-free now. Big money likes guaranteed returns. Zero reason to own equities until QE restarts. Rate hikes. Slowing housing market. Core inflation still too high. Federal government spending like there's no tomorrow, i.e., Israel, Ukraine, student debt, etc. Stuff like that makes people uneasy because it's all a recipe for more inflation, higher borrowing rates, and a reduction in purchasing power. All of those are bad for economic outlook. Probably because I remembered to invest the lump sum of my IRA about 3 months ago. There's a post on our small business right now that will tell you why. Overwhelmingly the posts are from small businesses owners sharing that their sales profits are going down over the past 3 months, as well as investments and projections going into 2024. I'm buying more SPY. It's a correction. They usually happen quite often. We were just spoiled from 2009 through 2021. I read this late October 2023. This decline can be attributed to the growing concerns surrounding rising bond yields and the apprehension that interest rates might remain elevated for an extended period. I think it's definitely a great buying opportunity, especially if you are a long-term investing. Don't mind dollar cost averaging, but each their own. Best to you. Because the era of cheap money is over. Because life is aggressively reminding me that I should celebrate the discounts I'm getting on my stock purchases while my retirement timeline is still 30 years out. The market is overpriced just like everything else. Hopefully it will be correcting itself over the next 3-6 months. It should be down 50 to get the averages back to historical multiples like 15 or 18. Treasury yields are probably the single biggest contributing factor. The 30-year Treasury was around 3.5 in spring. Now it's 5. That's a very significant difference and will weigh on asset allocation decisions. The more interesting question is perhaps how are stocks at 23x earnings multiples considering long-term risk-free rates. A treasury yields more than the stock market. That is very unusual. Now, a treasury's cash flows won't grow over time. But on the other hand, the risks on stocks are order of magnitudes greater. I find it much harder to understand why the stock market is still as high as it is, even considering the recent drop. Interest rates. Lots of people have good economics reasons here. But I think it's simply the fact that the recovery from March 2020 to January 2023 was an insane bull run. We dropped in October 2022 and then had another insane bull run. I never thought that made any sense. Recovery and growth was better than expected but shouldn't have been enough to drive insane stock price growth. My recollection, don't have a site handy, is that for most of the year, the Fed funds futures suggested the market anticipated rate cuts by the end of this year. Never clear on the rationale behind it. But as the market has absorbed the higher for longer narrative, equities have suffered. The Fed said they are raising rates again. The market is pricing in the hike. Don't know, but I'm buying. The S&P 500 is down because interest rates are up. The Mag 7 makes up a lot of the U.S. indexes. And higher interest rates reduces the potential revenue of said Mag 7. Also, it will affect spending, as people will face higher cost in their household. Also, fewer businesses and people will take out loans, as they can't afford it. This lowers sales of companies. It is a circle. Bonds. After a high capital injection from the Federal Reserve, it always comes a recession. It is a recalculation of acceptable P/E ratio with a higher for longer rates. I don't think it really matters. We've been in this strange chop box for a while, and I don't think spending time thinking about this is going to be productive personally. Higher interest on bonds makes them similarly attractive as stocks. Personally, I think the market has been overpriced for some time and look forward to a large crash, so I can gobble up some shares on the cheap. I think there's massive pain ahead and I look forward to seeing more blood in the street. Indeed, there's already some of my own out there. Up until September, rate cuts were projected to be happening as soon as early Q2 2024. Powell said this isn't happening again, and every data point has shown that as well. Markets are having to come to terms with rates going high since normal bonds are barely higher than treasuries, which doesn't really make sense. Regression to the mean?